this seminar. The seminar is hosted by Tax Justice Aotearoa and the Better Taxes for a Better Future campaign. And we're here to analyse Labour's capital gains tax policy, the political implications of that policy and where to from here. For those of you who aren't familiar with me, my name is Max Rashbrooke. I've got a long history of writing about issues of economic inequality in particular. I have columns in the Post and the Spin-off that I often use to write about tax. And I recently have co-founded a think tank called the Institute for Democratic and Economic Analysis, which is dedicated to tackling the issues of poverty and political exclusion. I'm very pleased to be hosting this event on behalf of the Better Taxes for a Better Future campaign. It's supported by a coalition of over 20 organisations. It's campaigning for a tax system that will enable us to gather the resources we need to fund the things that matter and to gather those tax resources more fairly. Now, for those of you who aren't already involved, the campaign would love you to get involved and support its work. They'll be posting some links in the chat for people to sign up, volunteer, and donate. For the moment, though, we're here to listen to three fantastic speakers discuss the topic of where to from here, what Labour's tax policy means for tax justice, revenue raising, and the 2026 election campaign. Obviously, the major context for this is Labour's announcement last week that it intends to run on what people have been calling a capital gains tax light, aimed at gains from residential property and commercial property investment. But that's in the wider context where the Greens have been talking about wealth taxes. Te Pāti Māori, the last election, had an extensive suite of taxes it was campaigning on. Conversely, the parties in the coalition government are generally committed to reducing taxes. So tax matters, tax is a hot topic. Tax is going to be a big part of the election debate next year. And so who better to explain that to us than Bill Rosenberg, Lisa Marriott, and Kassie Hartendorp. Now, I'll introduce each of them in turn when it's their time to speak. They'll each speak for about 10 minutes. And then hopefully at the end of that, we'll have plenty of time for Q&A. In the usual format for these things, please pop your questions in the chat, and then we'll get to them when it's time for the Q&A. Finally, just a reminder, a lot of you may be muted automatically anyway, but please do keep yourself muted if need be so that we have minimal disruptions for all our speakers. Now, like I said, I'll introduce each of the speakers in turn. So our first speaker is Bill Rosenberg. Bill is an economist who, familiar to many of you, is a visiting scholar at Victoria University of Wellington, Te Herenga Waka, and was formerly a commissioner of the Productivity Commission and economist and director of policy at the New Zealand Council for Trade Unions. As if that wasn't enough of a resume, Bill is also a member of the Tax Justice Aotearoa Committee and the chair of TGA's Policy Advisory Committee. So, Bill, the virtual floor is yours.
Thank you. I'll just try and share my screen.
While you're doing that, Bill, just hope everyone can see in the chat the various links that have been shared if you want to sign up, volunteer, or even just get updates on the Better Taxes campaign. To encourage everyone to get involved if possible.
Thanks, Max. Can everyone see that screen there?
Yep.
Yep. Okay.
Yep.
So I'll be talking about Labour's proposal and some alternatives to it. So just to outline, I'll first talk about, just describe what they proposed, and then I'll talk about what objectives it achieves and where its weaknesses are, and then show some alternatives that Tax Justice Aotearoa has been thinking about. So Labour's proposal is a tax on the income from capital gains, which applies only to commercial or residential properties, so that's buildings and land, and excluding the family home as the usual exclusion. The rate of the tax is 28%, the same as the company tax rate, but considerably less than the top income tax rate of 39%, which many of those who will be paying it will be on. It applies to sales made after a certain date, the 1st of July 2027, and only to gains in value since that after that point. It applies to New Zealand residents and entities and to non-residents. There are other exemptions for transfers between life partners of many kinds, and transfers at the end of such relationships, so divorces and similar, or death. The base valuation from which gains are measured from the 1st of July 2027, which is sometimes called Valuation Day, will be done by methods which are yet to be decided, but the tax working group, which this proposal makes heavy use of, gave a number of options, and we can discuss that later if people are interested. Profit on sale is after deduction of improvements since the later of the valuation day or the purchase date, and losses can be used to offset future capital gains on the same type of asset. So they can't be used for other tax purposes. And there are other details which Labor says will follow the recommendations of that tax working group that the last Labor coalition government set up. They estimate it will raise an average of $700 million per year in the first 4 years, though rising from a very small amount during that time to a significantly larger amount, and they say it will be at 1350 per year, but 1.3 billion per year from 2031 onwards. I've tried to do some calculations very roughly using the scaling up the tax working group figures, and these are probably in the right ballpark. They perhaps could expect it to rise more after 2031, but I think they're being conservative there. They've taken the step of pledging it essentially to funding their health system, not the entire health system, but features of it. So what to think about it? Well, firstly, it's well past time for Aotearoa to have a tax on the income from capital gains. And I like to express it like that because economists, tax experts, accountants, and many others will agree that this is just income. The profits made on the sale of an asset are just another form of income. So it should rightly be in our income tax system, and it's well past time for that to be included. The IMF, OECD, Treasury, and many economists and accountants all advocate for it. 31 out of 38 OECD countries have quite explicit, comprehensive capital gains tax regimes, and this includes countries that perform highly in economic and social terms, often better than Aotearoa. So it's no barrier to good performance in economic or social terms. The absence of a capital gains tax is a significant hole in our tax system for both income taxes and business taxes, personal income and business taxes, and that's used by the wealthy to minimise their tax. And so you may recall the study that was carried out in 2023 by ARD, looking at the 311, perhaps the wealthiest families and individuals in New Zealand, who they found paid under half the rate of tax of middle-income people, about 9.5%, whereas middle-income people were paying a bit over 20%. So this hole in our system greatly favours relatively few, largely wealthy people, and that graph on the right illustrates that point. This comes from the tax working group and shows that right over on the right there, 70% of the wealth that could be subject to a comprehensive capital gains tax, which is somewhat different from what Labor is proposing. It was owned by the wealthiest 10% of the population. Labor says only 10% of people will be affected by their tax. I can only take their word for that. The advantage of a tax like this is that the economic advantage is that it encourages the current setup with this hole in the tax system is that it encourages property investment and speculation rather than investment in providing jobs and raising productivity, raising the incomes that people can earn within New Zealand. So it has a capital gains tax has some economic benefits as well. Labor's proposal goes part of the way. It's useful in redirecting investment to more productive uses, but it's only a start in raising revenue and addressing inequities and inequalities. The very wealthy hold much of their wealth in financial assets rather than in property, and so a lot of that will not be touched by this proposal. So what are some alternatives? What else could be done or what complement Labor's proposal? The first thing to say is that we have substantial additional revenue needs coming up. We have the ageing population, which Treasury looked at in some detail in its long-term financial statement. There's still very large issues of poverty. Climate change will be a cost to the government. We have a struggling health system, and there's many other needs that are out there. A comprehensive tax on the income of capital gains is obviously one alternative, but one that clearly Labor has discounted, at least for now. A comprehensive one would cover, for example, land and buildings, as the current proposal does, but also shares, business assets, and intangible properties such as patents and crypto assets. The tax rate would be the same as income on personal income tax because it is a form of income. There would be exemptions as usual for the family home, and it's also appropriate to have exemptions for multiple ownership Māori land, which is unlikely to be sold. That would raise approximately, as far as I can make out, twice the revenue. It would reduce of the current proposal, and it would reduce tax minimisation and reduce inequities and inequality. The Tax Working Group report shows a version of this. Another possibility is a more progressive income tax system, untaxed at a low threshold, below a low threshold. We could address multinational tax avoidance. And so one proposal that Tax Justice Aotearoa has put forward is to tax royalties that are within the very heavy service fees that many multinational subsidiaries within New Zealand pay to associated companies. In other words, they pay to themselves. We could tax trusts, which are used by the wealthy to minimise and avoid tax. So one proposal there that we're putting forward is what we're calling an intergenerational 1% levy on assets in trusts above $5 million. And there are other measures that we could look at there as well. Perhaps more further out, we could look at, consider lifetime transfer taxes like Ireland has. It calls it the capital acquisitions tax, and it's a tax on substantial gifts and inheritances. And finally, wealth tax could be seen either as an alternative to this package, or could complement it at a quite high threshold. And whatever we do, we need much more transparency so we know really what is happening within our tax system and what is happening internationally. So in conclusion, I think it's important to support the introduction of a capital gains tax, but also to expand its scope. It will come under attack from vested interests, and we're already seeing that, and from political viewpoints representing them. They will try to exaggerate the number of people affected and the complexity of technical issues, but the technical issues can all be overcome. They will make claims about negative economic effects, but this isn't rocket science. There are options for design features that are well known internationally, and they're mostly described in that tax working group report. It's reasonable that some detail will have to be decided when expertise of officials is available. And positive economic effects outweigh the negative ones, which those who have been untaxed for years will highlight. So as I said at the beginning, most of the OECD countries which have had capital gains tax for years and just accept it as part of their tax system have better performing economies than ours. Thank you.
Well, thank you, Bill, for that presentation. Very helpful, very clear. Following on from Bill, we have Professor Lisa Marriott. Lisa is a Professor of Taxation at Victoria University of Wellington. Her research interests include social justice and inequality and the behavioural impacts of taxation. She's been awarded 2 Royal Society of New Zealand Marsden grants examining elements of justice within the tax system, has worked in the private sector in the UK and the public sector in New Zealand, and for the past 15 years in academia. So Lisa, take it away.
Kia ora, Max, and kia ora koutou. First of all, thank you so much for the opportunity to come and talk to you here today. I'm always so happy to see a large group of people who are prepared to give up an hour of their day to engage in tax issues, especially when you might be giving up your lunch break. Now, before I do anything else, let me just quickly share my screen. I just have a couple of slides that I will talk to. Just one moment. Always tricky with multiple screens. So 1 second.
We had it a second ago, Lisa. Now it's gone.
And do you know, I did touch anything? I do not know what happened. Yeah, let's try something else. Do you have it now, Max?
We do.
Lovely. Okay, I'm not going to touch anything apart from changing slides. So, kia ora koutou, thank you again for the opportunity to talk to you about this. It was great having Bill talk first and setting the scene and giving us a bit of the background of what this proposal looks like. I just have 2 slides I'm going to share with you today, and I'm going to start with some of the more positive elements of this proposed tax policy, and then I'll move on to some other parts of it that I do have some concerns with. So on the positive side, yeah, I'm really pleased to see us using the phrase capital gains tax. It does appear to be at least some step towards addressing wealth inequality. As Bill said, you know, we could have gone a lot further, but of course there is that trade-off between getting a policy that is acceptable to a reasonably large group of voters, but also achieving some of the objectives. So it's definitely a step in the right direction, because we are over-reliant on our revenue collection from consumption taxes and from income taxes. The hypothecation, I think, is really clever policy. There's research that very clearly shows that people are much more accepting of a new tax if it is earmarked for a specific type of expenditure. And there are 2 types of expenditures that are particularly positive, and they are health and education. So hypothecating this tax to health expenditure is a smart policy move. Now, the policy settings, I've put here relatively simple policy settings. They're never going to be simple, but at least at this point, it looks like they're not overly complicated. We've got quite a narrow base, as Bill has said, which may not necessarily be the best thing, but it does certainly lend itself to more simple policy, and that helps with compliance. And the adoption of, as far as I can see, a lot of the bright line rules is quite pragmatic. They've been tried and tested to some extent at least, so there's some efficiency gains to be made there. And actually, perhaps one other thing to say is, because we are starting sort of from afresh on this, if you ignore the bright line rules, we do have an opportunity to do this well and to learn from mistakes that have been made in other countries. And there are a lot of examples of how not to do this sort of policy out there. And so then looking at maybe the less positive, as Bill has said, it's pretty narrow. So we're targeting really just a relatively small group of taxpayers for special treatment, and that's always problematic from a coherence of the tax system perspective. It does exclude other sorts of wealth, and we've seen what's happened just recently with the interest deductibility on residential properties, for example, when we have had a relatively narrow group of taxpayers receiving that sort of special treatment. So I do worry that it is politically somewhat susceptible because of that. The other coherence element is with what might happen with losses. So normally with tax, we have a symmetry where income, if income is taxed, then losses are deductible. Here we have those losses ring-fenced, so they could be offset against other capital gains. So for people who, for example, might only perhaps have one residential rental property, if they sell that for a loss, then they're going to forfeit those losses. So there's a little bit of an absence of equity in that perspective. Now, the mansion effect, this is a fairly well-established problem with capital gains taxes in general. And what capital gains taxes do when your owner-occupied home is carved out is it encourages overinvestment in your own home. And that's because your own home is not subject to the capital gains tax. And this is fairly well established in places like Australia. But what it also can do is it can result in some other inequities. So, for example, somebody who can afford a very expensive home, say, $10 million, they're not going to pay capital gains tax on that. But you might have somebody who has a very modest home, say, I don't know, 500,000, plus a very modest residential property. And if we argue that that's the same amount, say 500,000, now that person has 10% of the wealth of the person who has the $10 million home, but they would be paying the capital gains tax on half of their wealth, whereas the person who has 10 times more wealth would not be. Some countries have tried to address this by deliberately including the family home within that capital gains tax sort of net, and then having a relatively high threshold. So your owner-occupied home is in there, but your first, I don't know, 5 million is excluded. There are, of course, as you can imagine, all sorts of political issues associated with even talking about having your family home included within the capital gains tax net. So Bill also talked about the 28% rate, and it looks like that is mostly the rate chosen because that is the pie rate. Now, but what it would mean for somebody, say for example, somebody who's perhaps retired and only having a one residential property and only, say, receiving New Zealand superannuation, they'd have a fairly low marginal income tax rate. If they sell their residential property, their rate that they would pay would be higher than their marginal income tax rate. And of course, for somebody who is working and paying 39% on a good salary, they would be paying less on their capital gains. I noticed the tax working group report did recommend having the capital gains tax to match the person's marginal income tax rate, and I'm not entirely sure why that wasn't adopted for this policy. Bill also mentioned my next point, which is about who is actually likely to pay this tax. And that high wealth individual report that Inland Revenue did a couple of years ago, that did have, and quite nicely captured the wealth that was held by the 311 most wealthy households in New Zealand. And the report found, and I'm just going to read a tiny bit from it, they said, capital gains are a significant source of untaxed income for high wealth families, and most capital gains accrue to those in upper net worth deciles. But many of those high wealth household asset categories were not residential properties or commercial properties, so they would not be people who would be paying a lot of this capital gains tax. One concern I do have is around valuation, and I know this has been pushed down the line a little bit, but I would have liked to have seen a little bit about how this valuation might work, because there's a date and people really need to know a little bit about how they are expected to value their property as of a specific date for tax purposes. I know in Australia the onus is on the taxpayer to get the market valuation, and obviously the higher that valuation is, the better it's going to be for the taxpayer. And I do have a concern that this is just going to create a new market for valuations, high valuations at for a price. And then finally, the lock-in effect. That's an effect which is already well known with capital gains, which is that properties don't get sold because they are going to generate a taxable event. So you have this lock-in effect where people are just holding on to their properties for longer than what they might otherwise have done. And given what we've seen here in recent times, and perhaps if we look at the interest deductibility on residential rental properties, we've seen a policy come in, and then we've seen that policy being repealed with a change of government. So, would we see people, if we have a change of government and the policy comes in, would we see quite a significant lock-in effect with people just holding on to those properties, waiting for a change of government, with the expectation that this policy would potentially not have, would not withstand that, which I hope provides a good segue into where Kassie might go next with her discussion. So that is it from me just for the moment. Thank you.
Well, and thank you, Lisa. Very useful, and thank you for keeping beautifully to time as well. That gives plenty of time for us to hear from our last speaker, Kassie Hartendorp. Kassie is whakapapa to Ngāti Raukawa and Ngāti Tuwharetoa. She is the director of Action Station, where she builds people-powered change for social, economic, and te tiriti justice. And her background is in youth work, Takatapui Rainbow Communities, and the trade union movement. Kassie, the virtual floor is yours.
Thanks, Max. Kia ora tātou. It's great to be with you here today talking about tax, and an extra special thank you to Tax Justice Aotearoa for organising, and Max, Bill and Lisa for your comments so far. As said, I'm here on behalf of Action Station, a progressive community campaigning organisation. I see many friends and allies in the audience, so kia ora tātou. We've been supporting the call for a capital gains tax for a number of years now. We believe that not only does it seek to rebalance our economy and ensure people with more wealth contribute back to our public services, but it moves us closer to a future where housing is treated as a need, not just a get rich quick scheme. I think I'll be telling a lot of you to suck eggs on this, but because I've got the 10-minute floor, bear with me and humour with me while I talk about some of this less from a tax analysis perspective and more from a social change and campaigning perspective. So often with social change, we usually get tricked into thinking it's a very linear pathway, right? From unfair policy to fair policy, from injustice to justice. But we also know it's never that simple, because at its heart, this is really about a change that people who have access to wealth, to resources and political power don't want to implement. They believe it will rightly threaten their interests, the interests of the people who helped them get to where they are now, and their way of seeing the world, and ultimately how it should work. So if this was all simply about implementing a sensible policy, then we would all have a free lunch break here today. But whatever we say about democracy in this modern world, the influence of political donors, the concentration of wealth and power, we also know that our decision makers are still beholden to the views of the public. And that's where we need to go next. So I have 3 observations. I'm not in the weeds around tax justice campaigning, but here are some of, I guess, the zooming out, some of the whakaaro that I have just looking in. Firstly, now is the time to go all in on winning over the public on tax. We know that it has taken a long time to get to the point where Labour has finally announced a bold-ish tax policy, and we know why. You could almost literally see Christopher Luxon rubbing his hands together in glee, knowing that in his mind, this is the political trap that they will win the next election on. They will throw absolutely everything at it, as Bill has mentioned, to tarnish the idea of higher tax and to try to bring down any left bloc parties that are associated with it. There are also easy anti-tax tropes we know that they are relying on. And yes, it's true that the story that they tell is compelling because it relies on those tropes. But the actual common sense sentiment among the public is not necessarily on their side. And that's where our political advantage lies. There is a growing understanding, thanks to many in this call who have been working on this, that we need strong public services. Taxes are an important way to provide for that, and there are many in a position to contribute more than they are currently giving. That is growingly becoming more common sense. I do think that Labour's announcement requires a shift in gear from a campaigning perspective. While our team agrees that the proposed CGT could have gone further, absolutely, and that we need other practical steps such as a higher company tax, a wealth tax, many other ideas that have been mentioned on this call, I do think that now is the time for a number of us to shift focus from the detail of the policy and into building the public support needed to get this over the line at the next election. I see it as we have a real golden window of opportunity over the next year where the government is failing on the economy, and that's showing up in the polls. They're deeply unpopular, and thousands upon thousands of people are going to fight for a one-term government. This really is the time to build the momentum for a change in political ideas and policy and make sure tax justice is a part of that wave, a necessary part of that wave. And if we do that work well, then we have a better chance of both shifting existing tax policy that's on the table closer to the election and create the conditions where further tax reform can take place in the future. My second observation is that we need to keep tying the idea of tax to the material needs of everyday people. I am one of those who spent last night crying tears of hope after seeing Zohran Mamdani win the New York mayoralty, an openly democratic socialist Muslim who faced millions and millions of dollars in attacks of people who didn't want him to succeed. And yet, the support for his campaign was monumental. He had the support of young people, working people, migrant communities, people who traditionally were not thought to care about politics. And he had over 100,000 volunteers, marking a new era of progressive leadership in the USA. He also openly campaigned on lifting taxes on wealth, but that wasn't usually the top line that he shared. It was largely about free childcare, city-owned supermarkets, driving grocery prices down, and free public transport, things that people were feeling the squeeze on and wanted real change, but have always been told that that is politically impossible. So tax is the recipe, but better lives are the delicious, joyful cake that we want people to smell, taste, and fight for. My third observation is that we can win. In late 2023, our team made a call to campaign on the Treaty Principles Bill. Our goal was to stop a national referendum on Te Tiriti happening at all costs due to basically the advice from our First Nations tuakana in Australia who had had such an awful experience of a referendum. We set goals such as make sure the bill is dead in the water before it is even introduced in the House, and ultimately to make it politically impossible for Luxon to say yes to this thing. And while we often treat it as inevitable now that that bill was always going to be dropped, that wasn't the case at the time. We went from a time when nobody cared about it. It was highly bureaucratic. Nobody even knew what the principles were, to seeing it slowly take over the airwaves and build a movement of people from all backgrounds, leading to the biggest hikoi of our modern generation and breaking historical records. And I personally have always been told in my role that we couldn't win public support on an issue for Indigenous rights. That was impossible. It would never happen. And yet that is exactly what this country did together. I'm not saying that we can follow the exact same formula, but we need to approach tax with the same fervour and determination that we have approached campaigning for Te Tiriti. And in some ways, it should technically, maybe, be easier because it directly impacts more of us. We know a fairer tax system offers a pathway out of poverty, out of crumbling public services and people dying in hospital waiting rooms. We need to keep making those connections, and we need to do it together. Because too often what I find is that people often think that campaigns are something that other people do. People like me or the folks from Tax Justice Aotearoa. But the real work of shifting people's hearts and minds to a place of just actual common sense, really, is done by the many, and that's how we will see the tide truly turn. That's how we build a critical mass and a new normal of where the government can no longer use tax as a political weapon against the people who need that reform the most. Lastly, I was struck by the comment by Mamdani that he said in his victory speech last night. It was of the Democratic Party, but I think it applies to all of us. We have bowed at the altar of caution, and we have paid a mighty price. Now is not the time to be safe and cautious, but to go all in, to stand firm on our principles and refuse to back down, to channel the energy of the wider movement that is building right now to win public support, to get CGT over the line, and to lay strong foundations for further tax change on the back of that momentum. Thank you for listening. Nō reira, tēnā rā tātou katoa. Kia ora.
Kia ora, Kassie. Thank you very much for that. Can see the appreciation coming through in the emoji. Thank you, everyone. That 3 great talks and bang on time, which leaves us some time for Q&A. Now, I can see lots of comments in the chat, and that's great. Do drop some questions in as well. I thought I might just use the MC's privilege to ask you all a question or two to start off with. One of which is about the attack lines on the capital gains tax policy. And as Kassie says, these are reasonably familiar. One of them that I think is interesting is specifically about trying to complicate the issue in the minds of voters. And I think for National and other parties, they are very aware that if you can confuse people about something, you can run the old Tony Abbott line. If you don't understand it, don't vote for it, because if you did understand it, you wouldn't like it. That's been a very powerful argument in the past. And the argument you can hear Nicola Willis making over and over again is this is not just a tax on residential property and commercial property, it's a tax on every part of the economy because everything's interlinked. KiwiSaver, investment funds ultimately will have some investments in residential property and commercial property. What about the dairy owner who might own the property in which they are running their dairy? So it's trying to basically say this will actually affect everyone and will have these terrible effects on everyone. That's very clearly the attack line. What I'm interested in, any of you, Kassie, Bill, Lisa, what are your thoughts about how that line is most effectively combated? There's a technical element to that. There's a campaigning element to that. Who wants to take that on first? Yes. Okay, Bill, you go.
Yeah, I'll make a few comments. This is certainly one of the tactics, and it was used when the tax working group was discussing a capital gains tax as well. On the complexity issue, actually, when it comes down to it, even what people consider as something they know, like income tax, is complex. we have something like 3,000 pages of tax legislation, not only about income tax, but about all our tax system. We have, in addition to that, regulations and guidance from the Commission of Inland Revenue and so on. So tax isn't simple. It's what people see when they pay their income and how it's administered that is important, really. And I think, you know, a well-administered capital gains tax doesn't have to look that complicated to people when they actually experience it. As far as the impact on the rest of the economy goes, well, in a sense, the intent is that it should have an impact on the rest of the economy and that it should be moving investment out of investment properties and pushing up the prices of them into more productive uses. So that's a plus rather than a minus, and that's what you can see. You know, that's what one would hope would happen from even this sort of entry level tax. As far as small businesses goes, the example of the corner dairy, the tax working group actually gave a concession to small businesses, which was that if they sell a building, for example, in that case, and with the aim of buying another one because they're expanding, for example, then they would not be liable for capital gains tax when they're swapping one asset for another one. And so, and there was also a concession if they were retired and wanted to sell that property on retirement. So if Labor follows those rules, then the likelihood of small businesses being affected by this is quite low.
Brilliant. Thanks for that answer, Bill. Kassie, anything to add from a campaigning point of view?
Just that, yeah, total what Bill said in terms of tax is always somewhat complicated, and certainly the implementation needs to be for a lot of reasons, because without that degree of complexity, we won't have an implementation that is actually fair and makes sense, you know, in the context as it is needed. So the details will always be complex, and how people interface with it might be complex, but we can't let that be used against us, because what I've noticed is that even the word complexity is often trotted out by politicians who want people to tune out of an issue. And it's always about coming back to it's actually very simple. It's very simple. We need our public services that look after to work, whatever the message is. I'm not saying that I know what it is off the top of my head. We need these things to serve us. The government has, I guess, you know, it's not in their favour, the fact that right now we have public services that are being deliberately starved of the resources that we need, so we can materially see what it looks like when we don't invest in these public services. It is a real lived experience of people right now, and in many ways that is the perfect you know, context to be able to say that more tax will solve this problem. We need to really get it back down to the most simple fundamentals, meet people where they're at, explain how this can be a solution. And for those of us who want to talk details, we should and we can, but for the rest of the public, we cannot let complexity be used as a narrative tool against us, which I've seen a lot of.
Brilliant. Thanks for both those responses. I've got a question from Roland Harrison, who's saying speakers have pointed out that CGT is well established elsewhere. However, he says capital gains taxes differ. Where does the Labour Party proposal sit relative to other capital gains taxes from around the world in terms of how comprehensive it is, the rate at which it is charged, and so on and so forth? Lisa, I wonder if you'd be happy to speak to that. How does Labour's proposal compare to capital gains taxes overseas?
Well, that's a really tough question, because one of the things with capital gains taxes is they're all so different. So this is definitely down the light end, you know, it's doing almost the bare minimum. But, when you look across capital gains taxes, a lot of them have exemptions, for example. So people can have on an annual basis a certain amount of capital gains before any capital gains tax might get started. As far as rates go, you see everything from discounted rates from income tax rates through to higher rates than income tax rates. Australia does something where if you hold an asset for more than a year, you get a 50% discount on the capital gains tax rate. There really is just no simple answer to that question. So sorry for that. But what I would say is the New Zealand or the Labour Party proposal is definitely down the light end. And in some ways, that's not a bad thing, because Kassie and Bill have both talked about complexity, and the more complex something is, the harder it's going to be to get the messaging across and to sell it. So it may not be a bad thing.
Brilliant. All right. Thanks for that, Lisa. We've got another question from Esme Gibbons, who asks, what is the best case study or research to point to with regards to concerns about capital flight? So this would be the concern, if you introduce this tax, then wealthy people will take their assets overseas. Who wants to take that on? Bill, Lisa, either of you got thoughts about that?
Well, it is, sorry, it's one of the beauties of land and buildings is you can't take them overseas. Sorry, Bill.
No, I'll just add to that. Exactly where would they go? Because capital gains taxes are so common around the world that they'll be taxed on their capital gains just about anywhere they will go.
Yeah. Great. All right, we have a question from a member of the press. Thank you, Tom Pulistreka, for joining us. It says, interested in any insight panelists may have on why Labour did not tack on an Irish-style capital acquisitions tax, which is something that Bill mentioned, which is effectively a life tax on the gifts and inheritance you received during your lifetime. Was opposition from the union movement a factor, as someone has suggested? So any views about the Labour policy process? I guess you could also use this question as a chance to talk about capital acquisitions tax more generally. Bill, you're the one who mentioned it. Any thoughts on that point?
I got absolutely no insight as to the Labour Party policy process on this, I'm afraid, Tom. And I hadn't heard that one about the unions, I'm afraid. I mean, the capital acquisitions tax is a way of looking at taxing the income people get through gifts and inheritances. It would be, it's generally at a reasonably high level, so that small gifts or inheritances don't get touched. But the reason why it affects both gifts and inheritances is that if you don't also think about gifts, then when you come to an inheritance tax, which again is a common thing around the world, then it can be avoided by making those gifts before the person dies, and you end up with an ineffective inheritance tax. Inheritance taxes are very important in stopping the increasingly concentrated wealth that you see in many countries.
Great. Thank you for that. Well, got a question from Louise Norton. So this is a bit of a devil's advocate question. Do you think Labour sees this as a safe and more palatable initial wedge and might intend to build on it later? Is it better to try to introduce a more comprehensive, fairer tax from the outset and risk greater opposition up front? Okay, so question political strategy. Kassie, some thoughts on that?
Yeah, I mean, I won't pretend to know what the Labour Party are deciding to do and, their rationale for this particular tax and the details. But I do think that, they definitely are playing it safe, right? We know that because there's a lot of things that they could be repealing and they're not really committing to repealing much. It seems fairly obvious that they're going to go on a few key policies that will, whether it's the jobs, homes, health type stuff, and focus in on that. I do think that the logic is to be able to build these palatable initial wedges and maybe test the waters and try to, at least what Labour often says to us is like, we need to be able to see more public support for things to be able to go further. I don't think they would be their exact words, but the reality is that if Labour only got to go so far to get over the line and to get into a position of power, there is a question about what we do outside that and what we're actually expecting of our decision makers in terms of going forward. So yeah, the more that I think about it, the way that I see it is that this is an opportunity. The decision has been made, the line has been drawn in the sand, even if it's a fairly weak line for many of us, and now is the time to really be saying, okay, now let's bring everyone else on a journey so that it is possible to be able to go further, either in advance of the election or on the other side. But I think that Labour will continue to play it fairly safe.
Brilliant. Thanks for that. There's a question that's occurred to me, and Bill, this might be one for you. You said you'd been looking at Labour's costings and sort of applying the tax working group's old working to it. What gives you confidence that idea that on average it would raise about $700 million a year in the early years is accurate? Because it's presumably it has to be based on the idea that people will continue to enjoy reasonably large capital gains in the world of residential property investment in particular. But we might be entering a period in which, wouldn't it be nice if house prices didn't accelerate in the way that they have done in the past? So is there a risk that this CGT doesn't raise the kind of revenue that Labour expects?
There's always a risk with CGT, obviously, because it's about capital, about asset price inflation, and that can be very variable and quite volatile. The tax working group figures were worked out on an average, and from memory, it was a 3% increase on average over a 10-year period. So from our previous experience, that sounds fairly modest when we've had significantly greater spurts of activity over that period. I think, from the point of view of the next 4 years, which is what Labour is looking at in its estimates, there is a risk that we continue to have, from the revenue point of view, that we have continuing stagnant or falling house prices, although there's some signs at the moment that unfortunately that's starting to wake up again in some places. But in the longer run, there are many pressures, I think, for house prices to rise, unfortunately, and all we can hope is that those rises are relatively modest. But over the longer run, I think that 3% increase per year is pretty modest in terms of our experience.
Sure, and actually, in just the question that's just come in that really speaks to that as well from Phil Major, what impact do you think the tax will have on inflation and property prices, bearing in mind that there has to be inflation for there to be tax revenue?
So that's one of the big questions that is debated, whether capital gains tax the degree to which capital gains tax puts a damper on house price rises, and it's by no means agreed by the research. Certainly, countries with capital gains taxes also have steep rises in property prices, and you can just look across the Tasman. Australia's had some quite steep rises in property prices, but if you look at New Zealand compared with those other countries, then in general, New Zealand has had faster rises than the others. Whether that's due to the lack of a capital gains tax or something else, it's hard to know. But it's kind of indicative, I think, that perhaps it does have a dampening effect, and it may slow the onset of a price bubble, because while really the bubble occurs when people see that the gains they make from selling are greater than the costs of selling. And there's always costs through real estate agents and in other countries, transfer taxes and that kind of thing. And so if you put some more sand in those wheels, then you may be delaying or even avoiding some of those price bubbles.
Brilliant. Thanks for that. All right, we're getting pretty close to the time, so I might just close with a couple of questions for Lisa and for Kassie, and hopefully relatively sort of quick fire answers. Lisa, you mentioned that you're worried that if there is a valuation day for this tax, then people will basically get very high valuations on purpose. So it looks like subsequently they haven't made very large gains. Is there anything we could do to prevent that from happening, to prepare against that? You're on mute, I think.
Am I?
Not anymore.
Can you hear
All good.
me? Okay, great. No, that's why I would have liked to have seen a bit more information about that valuation day. The tax working group did have options, but they're just missing detail. You know, it's all very well saying something like actual value or arm's length value, but you know, how do you actually get to that value? I think is the key. So it is a concern, and I think the potential for manipulation at that point is well, may exist.
Yeah, brilliant. All right, and Kassie, sort of, and the last question for you. I'm told by people who see a lot of focus groups that when you try out the arguments around capital gains tax, you know, the average sort of voter does still just bring up this idea of the mum and dad landlord, you know, that sort of fabled heroic beast, and they sort of say, oh yeah, but you know, these people they're painting the houses on their residential properties. They're going out there every weekend and mowing the lawns, and we just really don't want to be too tough on those people. Any quick thoughts about how that sort of line of argument can be counteracted?
Well, first of all, that is a story we've been told. Like, we've directly seen Luxon make that exact comment over and over and over again. So I think the first thing is to say is that any story can be shifted and any story can be planted. And so it is a matter of shifting that story to a bigger one. Like, yes, right now, that is the way that does exist. We don't lie, but that isn't necessarily the majority of landlords. We need to be shifting it to something a little bit more fundamental about the purpose of why this tax is important. And last, I just wanted to comment as well, you know, I keep banging on about this kind of golden opportunity, because the reality is that over the next year till the next election, there is this window that will probably quickly shut afterwards. People care about a certain issue for a certain amount of time. That window is now open. There will be people on the other side complaining against it and so on. And so I think we also just need to keep in mind that once the election is done and dusted, whatever happens will become part of the new political common sense for at least a couple of years afterwards. So if it really is a matter of striking while the iron is hot in this particular time, to shift that Overton window, to shift the public sentiment as much as possible, and then we're in a better position at the end of the election period.
Brilliant. Thank you very much for that answer. We've gone a fraction over time, so if anybody who needs to leave, please do so straight away. Otherwise, I just want to say thank you very much to our three speakers, Bill, Lisa and Kassie, for your insights today. Thank you everyone for coming along and for some great questions. Just to reiterate, Tax Justice Aotearoa, Better Taxes would love you to get involved in the campaign. So please, if you're interested, do sign up, fill out a form to volunteer, and make a donation, even if you're available. I think all those links have been posted in the chat. They'll also be emailed through to you along with the webinar recording and the slides. Last thing from me, next session in this Tax and Tuesday series about funding a better Aotearoa, why we need more revenue, will be on the subject of the capable state. There's an intriguing title. Tuesday, 25th of November, 12:30 to 1:30 p.m. It'll be in person at the PSA offices in Pornike or online. Thank you very much, everyone, for your involvement. I think it's been a fantastic discussion. Ka kite anō.